Hi, my name is Hamel. I'm a partner at HW LLP Advisors in Los Angeles, California. One of the things we do at our firm is we specialize in working with entrepreneurs like you as you navigate this strange new world of income taxes. One of the key decision points that you have very early in your business's life cycle is entity choice. So today we're going to talk about two entities. First is a C corporation. C corporations are popular, particularly when you have what we would say imminent venture capital funding. C corporations offer all the legal protections of any other business entity. The one thing that we don't like with C corporations that we'll talk a lot about today is double taxation. So let's take the example of buying an iPad for $10 and you somehow sell it for $100. Way to go. So you have $90 of income. What happens to that $90 of income? Well, it's going to get hit twice. The first time is when you report that $90 of income on your C corporation tax return. The feds and whatever state you're doing business in are going to take their percentage cut and assess an income tax on that $90. Then you say, well, what happens to the remainder? Well, the remainder you're going to take out of the business at some point in the form of a dividend. Well, what happens to the dividend? It shows up on your 1040, it's taxed again. This is what we call double taxation. Enter S corporations. S corporations alleviate this problem because they're what we call a flow-through entity. Unlike the C corporation, you've bought the iPad for $10, you've sold it for $100, you have that $90 of profit. On the S corporation, we'll report that very same $90 in profit. But we'll say to the government, we're not paying the tax at the S corporation level. That $90 is going to the owner, to the shareholder, to report on his or her 1040. So what happens there? You pay one tax at your individual tax rate. We've escaped the issue of double taxation, thus the reason that S corporations exist. However, as you'll find as you journey through this strange new world, you can't have it all. There are drawbacks with S corporations, and I want to talk to you about a couple of those things today. S corporations offer all of the formality of a regular corporation, keeping minutes, following the corporate laws, records, all of those things. They also have some other drawbacks. You're limited in terms of the structure of how you can get money out of these entities, unlike a more flexible entity like an LLC, which we've talked about in other videos. On the S corporation, any money that you take out of it in the form of a distribution has to be proportionate. So if you have two 50% owners, you take $10 out, your partner takes $10 out. That's a significant limitation. You have limitations on who can own the business. You can't have a trust own the business. You can't have a foreign individual who's not a U.S. resident own the business. You can't have over a certain number of shareholders in the business. So there are limitations and drawbacks in terms of the structure of an S corporation. One other benefit of an S corporation is the ability to carve out part of your earnings from self-employment taxes. And that's a concept versus an LLC that we'll talk about